Although Trump says that he's a low interest rate guy, there's nothing he can do to control long-term interest rates, which are headed higher unless there is a marked downturn in the economy. I suspect they're headed back to and beyond the levels we saw in the early 80s. Bonds are a disaster in the making. Don't forget that, as important as this election was, it can't immediately undo decades of economic and cultural debauchery. It's no coincidence that we see inflation once again rising from 2.3% in September to now 2.6% in October, and there are plenty of categories that are way more than that 2.6%, especially the things that people buy on a regular basis. Health insurance is up 6.8%. Car insurance is up 14%. Airfares are up 4.1%. Housing costs are up 5.2%. Daycare is up 6%. Sure, there are obviously categories where prices have fallen. And congratulations if you were in the market for a men's sports coat last month. You paid 5.9% less. Plus, the all-important dishes and flatware category plunged 7.4%. But these hardly make up for the big price hikes in the key categories that are essential to most people. This is what makes the Fed's policy actions so bizarre. Last week, they cut rates again for the second time this cycle, which is the opposite of what a central bank would normally do in the face of rising inflation. In the same way that they pretended inflation was transitory throughout 2021, they are now asserting with equal vigour that the inflation beast has been tamed. They are so full of self-congratulatory hubris, in fact, that Fed Chairman Jerome Powell stated that he'll refuse to step down if Donald Trump demands his resignation. Bear in mind, Powell is the guy who totally missed inflation in 2021. I mean, he was Mr. Transitory. He failed to act in a timely manner and waited until mid-2022 to start hiking rates in earnest. He then failed to predict any negative consequences from the rate hikes, including the meltdown in the US banking system. Powell even testified before Congress just 2 days before Silicon Valley Bank went bust last year that he saw nothing in the data to suggest that there were any risks to the Fed's monetary policy decisions. I would also point out that during Powell's chairmanship, 2 of the most senior Fed officials were found to have been personally profiting from their monetary policy decisions through questionably timed stock trades. It was almost as if Nancy Pelosi was running the joint. So, Powell, who's been consistently wrong in the most remarkable ways, now insists that he will not step down. Apparently he, and he alone, can lead the Federal Reserve. This is the kind of arrogance we've seen before from Joe Biden, Tony Fauci, etc. It's not a good look, and it doesn't bode well for the Fed. All that aside, it's pretty clear that the Fed is in a bind. Inflation is rising, so they should realistically hike rates. But interest rates, even at current levels, are killing the federal government. The US spent an unbelievable $1.1 trillion in the last fiscal year paying interest on the national debt. That will almost certainly increase for this current fiscal year. If rates stay where they are now, the total interest bill will exceed $2 trillion in a few years. That's a pretty bad situation, considering that interest rates are still relatively cheap on a historical basis. But it's not just the federal government. Current interest rates are also bad for banks. Remember that banks across the United States bought mountains of Treasury bonds during the pandemic at a time when interest rates were at record lows and those bonds yielded as little as 5 basis points, i.e. 0.05%. Thanks to the Fed's interest rate hikes, those banks' bond portfolios have tanked in value. When interest rates go up, bonds lose value. In fact, across the entire US banking system, the total unrealized bond losses exceed $500 billion. That's about 20% of the total capital in the US banking system. Naturally, banks don't want to take that hit. The only way to unwind those losses is for interest rates to fall, i.e. the bonds once again increase in value. So yeah, banks desperately want rate cuts too. But the most important one is the Fed itself. Just as in the same way that banks across the country bought US government bonds during the pandemic, the Federal Reserve bought literally trillions of dollars of bonds, and their interest rate hikes have caused unbelievable losses to the Fed's own bond portfolio. Their losses amount to about $1 trillion. In other words, the Fed is wildly, woefully insolvent. And at this point, they're just out for self-preservation. Cutting rates is the only way to reduce those unrealized losses and prop up their solvency, even if that means more inflation or even stagflation that could be worse than the 1970s. That's especially significant since during his last press conference, Powell admitted that the Fed has no contingency plan for stagnation. They're not even thinking about the risk. They're just focused on saving themselves at your expense. In general, being born in America with low taxes, the rule of law, sound money, limited government and relatively limited regulation was a good choice to make since 1900. More public companies are formed and are successful in the US than anywhere else in the world. They are also subject to more extreme valuations, the ups and the downs. Second, UBS puts out an annual outlook of global investment returns each year, which takes a big picture view of financial markets. Other than a brief period at the start of 1989, where Japan was 40% of the world markets and the US just 29%, US stocks have been the best game in town for 100 years. Japan's dual bubbles in real estate and stocks crashed so hard that they still haven't recovered and may never do so, given Japan's steep demographic decline. You can see that at over 60% of total world market cap, the US is just above where it was in the Cold War, and LBJ's Great Society became too much. The stock market crashed. The gold dollar broke. Inflation dominated the decade. Interest rates soared. And now, well, that's the question, isn't it? US consumers have piled up the largest mountain of household debt in the history of the world. If the federal government was not almost $36 trillion in debt, the fact that US households are nearly $18 trillion in debt would be making a lot more headlines. The entire society is saturated with debt. Government debt on all levels is spiraling out of control. Corporate debt has ballooned to absurd levels, and consumers have been gorging on debt as if there were never to be any consequences. Unfortunately, the time of reckoning has arrived, and it's going to be incredibly painful. The other day, we learnt from a new report on household debt from the Federal Reserve Bank of New York that Americans' total credit card debt had surged to a record high of $1.17 trillion. Credit card balances rose by $24 billion in the third quarter of 2024 and are 8.1% higher than a year ago. Needless to say, incomes have not increased by 8.1% over the past year. So credit card balances are growing faster than paychecks are, and that's a problem. Meanwhile, total student loan debt has reached a new high of $1.61 trillion. It appears that 30% of all student loan borrowers have gone without food or medicine due to their monthly bills, according to the Consumer Financial Protection Bureau. In addition to skipping necessities, 38% of people with federal student loans said that they carried credit card debt that they wouldn't have otherwise, the Bureau found. Around 44% of borrowers said that their education debt delayed the time when they could buy a home, and 26% said the debt pushed back the moment when they might otherwise start a family. If you are a young person considering going to college, you should try to avoid piling up student loan debt. It can haunt you for decades. Overall, total household debt in the United States has skyrocketed to a new all-time high of $17.94 trillion. The Federal Reserve Bank of New York's Center for Microeconomic Data has just issued its quarterly report on household debt and credit. The report shows total household debt increased by $147 billion, 0.8%, in the third quarter 2024 to $17.94 trillion. What a nightmare! How did the United States of America ever allow its citizens to pile up nearly $18 trillion in household debt? That is utterly insane. People's wild spending gave the appearance of fueling solid economic growth for a long time. But now most consumers are just barely scraping by from month to month, and businesses all over the country are deeply struggling as a result. For example, US retailers have announced the closing of 6,481 stores so far in 2024. US retail closures have reached the highest level since the COVID-19 pandemic, according to recent estimates. As of November the 8th, retailers have announced 6,481 store closures, an increase of 336 closures in just 1 week, according to the latest data from CoreSite Research. The majority of these closures were driven by American Freight, which is shutting all 329 of its locations as part of its parent company's bankruptcy proceedings. Meanwhile, the auto industry is having a very tough time adjusting to lower consumer demand. 2 weeks ago, we learnt that Nissan will be eliminating 9,000 jobs and a fifth of its manufacturing capacity. This caused its stock to lose 6% in 1 day. It's struggling with sales in China and the United States. 10 days ago, Japan's third biggest automaker slashed its forecast for a full operating profit by 70%. It said restructuring would cut costs by 400 billion yen, or $2.61 billion, in the financial year to the end of March. This is very painful. Stellantis is another automaker that has decided that it's time to reduce production and lay off workers. Stellantis is indefinitely laying off more than 1,000 employees at its Jeep assembly plant in Ohio, as the automaker significantly reduces its inventory levels to match demand. Stellantis, the parent company of Chrysler, Jeep, Dodge and Ram, issued worker adjustment and retraining notification, or WARN, notices to the respective state and local governments, as well as the United Auto Workers Union. The 1,100 layoffs at the Toledo South Assembly plant will be effective as early as January the 5th. Unfortunately, I think this is just the beginning of very tough times for the auto industry. The tech industry is facing enormous challenges too. In fact, chipmaker AMD just announced that it will be reducing the number of workers that it employs globally by about 4%. Quoting an AMD representative, "As a part of aligning our resources with our largest growth opportunities, we are taking a number of targeted steps that will unfortunately result in reducing our global workforce by approximately 4%. We are committed to treating impacted employees with respect and helping them through this transition." End of quote. At least AMD is still treading water. There are countless other firms that are falling apart right in front of our eyes. Spirit Airlines is one of the latest victims. Spirit's share price suddenly crashed when it announced that it will be filing for bankruptcy. This, of course, sparked fears among flyers about mass cancellations. After news broke about the bankruptcy emerged on Tuesday evening, Spirit's share price plummeted 45% in just seconds, erasing hundreds of millions in market value from the carrier. By Wednesday morning, it was down by 70%. The Florida-based low-cost airline is in final negotiations with bondholders on a restructuring plan to secure the support of key creditors, the Wall Street Journal reported. It owes more than $3 billion. This is how a debt bubble bursts. At this stage, things are so bad that even CNN is getting ready to conduct some very harsh layoffs. CNN is planning to wield the axe on some of its high-paid staff after dismal election ratings that cap off a disastrous period for the cable news network. According to an explosive new report from Puck network executives, will unleash sweeping layoffs in a bid to save the network's flailing reputation. It comes after the departure of stalwart Chris Wallace and amid reports that senior stars like Wolf Blitzer and Jake Tapper have both been denied raises. Of course, the carnage is not just limited to large businesses. The percentage of small businesses that cannot pay their rent has reached the highest level since the peak of the pandemic. Close to half small business owners couldn't pay their rent in September, marking a new 3-year high. According to business networking platform Alignable's September Revenue and Rent report, 48% of small business renters couldn't make their rent payments. That was up from 41% in July and August. It was the highest it's been since the COVID recovery era in March 2021, when 49% of small business owners were delinquent. So here's the bottom line. For years, Americans were able to enjoy a ridiculously inflated standard of living by piling up staggering amounts of debt. But now that debt bubble has started to implode, and a tremendous amount of pain is on the horizon. Going into massive amounts of debt may be comfortable for a while, but it always catches up with you in the end. Those who are telling you that there's an easy way out of this mess are not being honest. America as a whole has only itself to blame for what's about to happen.